when IFRS Foundation issued the full IFRS, we'll be talking about full IFRS as we have been doing in other workshops, and then we'll be talking about IFRS for SMEs, the one that we're introducing today. When the IFRS Foundation, ISB, issued the full IFRS, they got comments from the market, from their customers, meaning the users of IFRS, that it's complicated. There are certain businesses that do not require that full disclosure because it's complicated. It's long. It requires certain skills. So those businesses just needed a reporting standard that's just simply and straightforward. So differential reporting, it refers to various levels of compliance which apply depending on the category of company. So this standard IFRS for SMEs was then introduced so that your smaller and less sophisticated companies are able to produce financial statements using nothing but a simple set of reporting standards that do not require some complex, some standards, certain skills. Those smaller companies do not have the resources to employ CAs, for an example, or people who have got expertise of full international financial reporting standards. So they just want something, clear and simply and straightforward. So what you have, you've got small entities will need less complex financial statements because their users are generally involved in the management of the entity. As you can imagine, your smaller companies, someone starting a company, they will be involved in the day-to-day management of that entity. So come end of the year, who exactly are they reporting to? It's someone who has been involved in the business. So it's unlike in very large entities, listed entities, or even if not listed, but big companies where you've got shareholders sitting somewhere in Mauritius. The company is here. So that shareholder wants to know what has been going on during the financial year. So the level of disclosure there of the things that have been going on throughout the financial year will be more information so that that particular shareholder knows what went through in the company. Unlike when the person who is a shareholder, is a director, is also running the company. So basically that's what differential reporting is. Reporting depending on the category of a company. If it's more, if it's more complicated, the company has got what we call it public accountability that I'll cover just now, then that company will then comply with what we call full IFRS as opposed to IFRS for SMEs. All right, now let's quickly look at what is an SME, small and medium-sized entity. Because ISB or IFRS Foundation, they are, as the name says, they issue international financial reporting standards. So it's for everyone right around the globe. So what they have done, they have not prescribed, like in South Africa, there are various categories that a company whose turnover maybe is not more than 50 million can be categorized as an SME. You will not find that in the IFRS for SME standard. They did not go that route in terms of prescribing what should be the revenue category for a company to be an SME. But what they did, they sort of gave these key concepts. The first one is that if a company does not have what we call public accountability, two, if a company produces or publishes general purpose financial statements, then those are entities that are categorized as an SME. What is an SME? What is public accountability? Where the company has got debt or equity instruments publicly traded, that company, we can then call it has got a public accountability. So most of the companies that are in the SME category are those companies at the corner of whatever street, just next door to you. They are not listed in the JSE, whether in the main board or even in the AIM listed another in JSE. Then the other one is that where a company has got, or rather a company whose primary business is to hold assets in fiduciary capacity, like having the legal authority and duty to make financial decisions for a broad group of outsiders, your banks, your insurance companies, your mutual funds. Those companies, your banks, insurance, because they deal with, they take money from me, you and me, those ones, they've got public accountability. So just with the information that we have here, it just definitely means your bank, your insurance company, your mutual fund company cannot use IFRS for SME as a reporting standard because they've got what we call public accountability. So those ones definitely must publish their financials using the full IFRS, not the IFRS for SMEs. Okay, so key concept to keep in mind is the public accountability. Once the company has a public accountability, then it must use full IFRS, not IFRS for SMEs. All right, what exactly are we talking about when you're saying full IFRS versus IFRS for SMEs? Now, the IFRS for SMEs is just drafted in simply English. You know, the IFRS or the ISB tried to simplify the terminology that is used as opposed to full IFRS, you know, just to make sure that there is no ambiguity for someone preparing financial statements using IFRS for SMEs. There's nothing that requires some sort of consultation with someone who's been trained on IFRS. You know, it's just simple and straightforward. Some sections are very similar, whereas others differ because the full IFRS has been adopted to take into account SME reporting needs. And then you guys will just go through, there are certain sections that you have gone through either in ACCT 2W1 or currently ACCT 212, where we'll just see what are some of the sections in full IFRS and what are some of the sections in IFRS for SMEs. Quickly, if you go to full IFRS, there's conceptual framework, there's IS1, which is the presentation, IS16, PPE, IS38, etc., etc. But on the other side, the IFRS for SMEs, as I said, it's not that long. It has got just sections. You do not have independent, you know, sections. You've got just section 2, which is conceptual framework, section 3, 4, 5, and 6, 8 for presentation, IS16 in IFRS for SMEs, it's section 17, etc., etc. You have done those standards up until IFRS 16, which is leases, which you'll get it in IFRS for SMEs, it's section 20. Then the standards that we have done now, IS 37, IS 10, IS 8, we've done groups, IFRS 9, IS 21, and IS 7, the statement of cash flows, which we were doing last week. Then those are sections that you'll find in IFRS for SMEs, you know, section 21, 32, 10, 9, 11, 30, and 7 as well in the IFRS for SMEs. So it's just guys showing that whatever that you have done in the full IFRS, it's sort of covered in the IFRS for SMEs. And it's just that it's more simplified in the IFRS for SMEs. And then there are differences here and there. We try to highlight them in this workshop. We might not necessarily cover all of them, but just to indicate some of the differences between the full IFRS and the IFRS for SMEs. But the key issue is the simplicity. IFRS for SMEs trying by all means to simplify some of the things that you will find in full IFRS. Okay, now let's quickly look at the statement of comprehensive income. What does IFRS for SMEs say versus the full IFRS? IFRS for SMEs does not address presentation of segment information, earnings per share, EPS, or interim financial reports by small or medium-sized entity. So if you take your IFRS for SMEs standard, you're not going to get those. It's not there. Probably the thinking is for a small company, it does not need to report on segment information. There's not much on earnings per share or interim financial reports as well. Now, that does not mean that a company that is preparing its financial statements using IFRS for SMEs cannot disclose that information. It can. The only thing is, if it chooses to disclose, let's say, segment information, then it must indicate by way of a note as to what basis, I'll imagine it will be using the full IFRS. So it must disclose that we've prepared segment information using full IFRS, because there is no section in the IFRS for SMEs that deals with segment information. Same as earnings per share or interim financial reports as well. Then it means even you, one day you become an auditor, you go to a company that has prepared financial statements using IFRS for SMEs. You cannot go there and then say, where is earnings per share? Where is the segment information? The financial statements are not complete, because we are used to seeing a complete set of financial information with segment information. If it's IFRS for SMEs, the client will laugh at you, because the client does not have the requirement to report on segment information. So that is something to note. And then the other one, which is the last bullet point, is that the full IFRS requires disclosure of nature of expenses. If statement of comprehensive income is shown by function, you can get that information on page 101 in your textbook. Whereas IFRS for SMEs does not explicitly require these additional disclosures. What exactly are we saying here is that if an entity chooses to disclose its expenses using, remember, you did this in first semester, using the function method, for instance, then it must disclose the nature of expenses by way of a note. Why is that? It's because if you disclose using the function method, you only have it's the sales, distribution, administration, and other operations. You will not see in the face of the financial performance statement or comprehensive income things like depreciation, for instance, and amortization. So for that one, you'll have to disclose it by way of a note. But here in IFRS for SMEs, there's no requirement for that. Even if you decide whether you use the function or the nature, you do not necessarily need to disclose it by way of a nature and by way of a note. But having said that, it's always important when you prepare IFRS to keep in mind that you are actually communicating. So if you are communicating like I'm doing now, I must try by all means to see to it that you guys understand what I'm saying. So if you are communicating, try to put the users of the information in your head, so that they'll appreciate, they'll see exactly what you are communicating. So it's always, it's very important. And I'll imagine you can go back to your textbook so that you go through some of the principles when it comes to reporting, prudence and all those things, that they are still equally applicable here. Okay. Then continuing with the statement of comprehensive income. Now, the other comprehensive income for full IFRS, there are 10 items that you need to disclose. They're in your textbook, page 99, section 83.3.3. When it comes to IFRS for SMEs, it only requires gain and losses arising on translating the financial statement of a foreign operation, actuarial gains and losses, fair values of hedging instruments, and just the revaluation surplus for PPE. All the other requirements for statement of other comprehensive income as per full IFRS are not necessarily important. So it just requires those 4 items. And equally important is that if a particular client where you are preparing AFS, they do not have one of those that are listed there, it does not mean your other comprehensive income should then reflect that, because you happen to know that the statement of other comprehensive income must, as an example, have fair values of hedging instruments. If there is no hedging instrument, there's no need to disclose fair value of hedging instruments, because there's just none. But as a minimum requirement, those are required when you're disclosing the statement of other comprehensive income for IFRS, for using IFRS for SMEs, just those 4 as opposed to 10 in the full IFRS. If you've forgotten those 10, you can go to page 99 of your textbook. Okay, let's see the statement of changes in equity. Right now, if only changes to the statement of changes in equity or to equity during the particular period are only related to profit or loss, payment of dividends, corrections of prior period errors, and changes in accounting policy, IFRS for SME stipulates that you can present just a single statement of income and retained earnings instead of what we are used to, where we present a statement of full statement of comprehensive income and then a separate statement of changes in equity. IFRS for SMEs says you can just present a single statement of income and retained earnings. So that's, as I said, that's the way of simplifying the full IFRS, because they know, the drafters of the standard, that for smaller companies, they are really not complicated. It's not much. So you may just write in your statement of, just present statement of income, then together with retained earnings all at once, and you are good to go. What exactly are you going to present in the statement of income and retained earnings? Just retained earnings at the beginning of the period, dividends declared and paid or payable during the period, any restatements that you might have of retained earnings for correction of prior period errors, restatements of retained earnings for changes in accounting policy, if any, and then retained earnings at the end of the reporting period. Simply and straightforward. As I said, instead of presenting the full set statement of comprehensive income, statement of changes in equity, it's just one statement, statement of income and retained earnings. If you want further information, as I said, you can download to the statement, and then it's in section 5, which covers the statement of comprehensive income in the IFRS for SME standard. Okay. Right, let's proceed and quickly look at the statement of cash flows. We did the statement of cash flows, if I remember correctly, last week. Now, the the full IFRS, remember we said we've got two methods, which is the direct and indirect method. The IS7 requires, which is the full IFRS, not necessarily requires, I'll say it promotes the use of the direct method. As we said, if you're using the direct method, you still need to know the indirect method, because that one will come out as a note in any case. So you need to know both. So, but in the IFRS for SMEs, it does not necessarily explicitly encourage entities to report or using report from cash flows from operating activities using the direct method. So here the entity will be it can pick up any method. So and then the other one is that when it comes to full IFRS, there are certain cash flows that can be offset and reported on a net basis, unlike in IFRS for SMEs, which does not necessarily have that requirement. What are some of the cash flows that can be offset? By way of example, let's take just a practical example. An estate agent which deals with rentals, they will have their client, who is the landlord, and then someone renting that particular building or whatever. So what the estate agent will do, will charge the tenant at the end of the month, let's say it's 10,000, 10,000 will be paid by the tenant to the estate agent. The estate agent will take their commission, admin fees, whatever, let's say it's 1,000 rand, and then pay the landlord 9,000. So when it comes to offsetting, the principle of IS7, it says you need to report on gross basis. In other words, you need to report that you have received 10,000 and then you pay 9,000. But in certain cases, like the example that we are using, in that instance, the estate agent will only report the revenue from customers of 1,000 rands, not on gross basis, the 10,000 and 9,000 paid to the landlord or to their customer. So that is what we're talking about when we're talking about offsetting, you know. But IFRS for SMEs does not necessarily have that requirement. You know, there's no offsetting of some sort. That's here. That's as I said, it's just a way of simplifying it. Okay, let's go to errors and change in policies. Now, full IFRS requires a third year to be presented in statement of financial position prior year, but you will not necessarily find this in IFRS for SMEs. Therefore, only 2 periods will be presented. A quick example, this one, I hope you'll remember it. It's your test one. Test one it was a change in accounting policy, change in inventory valuation. There were 3 years. There was 2020, if I remember correctly, 2020, 2019, and 2018, you know. So in this IFRS for SMEs, the disclosure is just for basically 2 periods. Not necessarily, you wouldn't go back after we have made a change in accounting policy. All right, now let's quickly look at the investment property. Again, let's see, there's someone who said, when will test one results be released? I'll imagine this person maybe came a bit later. I've indicated that those results will be released either today or tomorrow. All right, investment property. IFRS for SME standard does not specify how to classify land held for the undetermined purpose. If you recall, if not, you can go to your textbook, but full IFRS requires, if there is a land that is held for an undetermined purpose, the client is not sure what exactly should be that land must be classified as investment property, but there's no requirement like that under IFRS for SMEs. Secondly, reconciliation of opening balance to closing balance only needs to be presented for the current year. I think it was your catch-up for those who were doing ACCT 2W1 first semester. It was your AgroTET or your catch-up assignment. There was an investment property question where you had to disclose the investment property. There you needed to show both the years. I cannot recall the years that were there, but if it was 2020, you needed to disclose 2020 and 2019, having reconciliation of opening balance at the beginning of the period, whatever that went through, whether there were additions, whether they are disposals, the fair value adjustments during the year, and then at the end you'll have the closing balance for both years, 2020 and 2019. But under IFRS for SMEs, there's nothing like that. If you have investment property, you need to disclose it. You'll only have 2020 opening balance, whatever that happened during the year, and then closing balance. You'll not necessarily have the 2019 financial year. That's what IFRS for SMEs requires. The other one, which is the third bullet point, on top of the disclosure, is that in full IFRS, every year we need to get the fair values. If we are carrying our investment property on valuation basis, we need to get the fair value, But here it's only investment property whose fair value can be measured reliably without undue cost or effort on an ongoing basis is accounted for in accordance with this section, meaning at fair value through P&L. All other investment properties are counted using the cost model. You can get that section 17 and remains within the scope of section 17 unless a reliable measure of fair value becomes available. And it is expected that fair value will be reliably measurable on an ongoing basis. Basically, what does that mean? It means that if you're using IFRS for SMEs, you've got investment property, you just carry it at cost model. You're not going to use the investment, you're not going to use the fair value model. So you'll be just carrying it at cost model. You don't have to be determining the fair value each and every year because of what the cost that is involved and the effort, unless you can say there's really not much cost that is involved or not much effort, then you can opt for the fair value method through P&L. But the standard says just carry it at cost, then there is no requirement for you to fair value the investment property. Same story if we go to a client, the client prepared in financial statements using IFRS for SMEs. We cannot say, Mr. Client, why didn't you fair value the investment property and issue a finding based on that? No, it's not. The client will laugh at us. We can't do that. If the client is using IFRS for SMEs, there is no need to be fair valuing in inverted commas the investment property every year. There's not such requirement in IFRS for SME standard. Okay, now let's quickly look at PPE. As I said, ladies and gentlemen, these are standards that we have already done, whether this semester or last semester. PPE, I know we have done it in the first semester, which is IS 16. Here, an item of PPE may be acquired in exchange for a non-monetary asset or assets or a combination of monetary and non-monetary assets. Then an entity shall measure the cost of the acquired asset at fair value unless the exchange transaction lacks commercial substance or the fair value of neither the asset received or that one given up is reliably measurable. So in that case, the cost of the asset will then be measured at carrying amount of the asset given up. Now, what exactly are we saying here? Let's make a quick example. Let's say after you finish, you've done your articles, you've qualified as a CA, and then you decide to start your own accounting practice. You've got a brother who's an engineer, he has got his own engineering firm. Your brother buys a MacBook, latest MacBook, it's 30,000 laptop. You have used this old Baki when you're doing your articles. Let's say it's now having a carrying amount of 35,000 because it's a bit old already. You know, we have been using it for quite some time when you're at university and when you are doing your articles. Okay, now you come to an agreement with your brother. You say, okay, I'm starting an accounting firm. I want to project a good image of my business. Can you give me the MacBook? And your brother, because he's an engineer, he can use the Baki when he goes into sites and things like that. So your brother gives you the MacBook. Let's say scenario number one, he knows that the price he bought it at iStore, he kept the slip 28,000. You also happen to know the carrying amount of your small Baki, it's 35,000. So in that instance, if he gives you the MacBook, when you take it in your own books, you'll put it at 28,000 as per the receipt from your brother. You know, let's take another instance. Let's say he doesn't know the price of the MacBook, bought it a couple of months ago. He has lost the receipt or the slip, and then he gives it to you. So what this is saying is that in that instance, the cost of the MacBook in your own books will be the carrying amount of the small bucket that you are giving up, meaning it will be the 35,000. You know, so that's basically what they say. Full IFRS, the last paragraph specifies it should be the fair value of the asset given up unless the fair value of the asset received is more clearly evident. If it is the only fair value or if it is the only fair value available, you can get that more clarity in your book, page 367. Okay. So continuing with PPE, again, full IFRS requires an annual review of your residual value, useful life, and depreciation method. So if we are auditors, we go to a client. When we come there, we will want proof every year that the client has sort of undertaken some exercise of reviewing the residual value, the useful life, and depreciation method under full IFRS. If the client is using IFRS for SMEs, now there is no such requirement. You cannot necessarily demand or require the client to have reviewed the residual value, useful life, and depreciation method. IFRS for SMEs only requires a review only if there's an indication that there has been a significant change since the last reporting date, provided there's something that we can say it brought some changes that required that an exercise be taken that will result in the review of a residual value, useful life, and the depreciation method. Otherwise, there is no such requirement under IFRS for SMEs. And then the other one is that IFRS for SMEs requires that the whole class of PPE be revalued if revaluation model is selected, but does not specify that this will be on the same date as the full IFRS. What does that mean? Basically, if we have got full asset, let's take we've got an asset class of PPE, we've got motor vehicles. IFRS for SMEs requires that we revalue, if we are on revaluation model on PPE, remember, we still under IFRS for SMEs, like in full IFRS, we can choose whether we're on cost model, on PPE, or we're on valuation model, unlike in investment property, where we can just stick with the cost model. But for PPE, we can choose to be on the revaluation model. If you are on the revaluation model, full IFRS requires that we undertake the review of that asset class, same as IFRS for SMEs, but full IFRS says undertake that exercise on the same date. But IFRS for SMEs, there's no such requirement. You do not necessarily need to review all those vehicles on the same date if you are on IFRS for SMEs, unlike the full IFRS. Okay, and then the last part is that when you disclose, as we know, the PPE note, when we disclose the PPE note, just on top of our heads, we know that if we're complying with IFRS, even in tests or exams, when you are asked to disclose the PPE note, the examiner does not necessarily, as long as there's an indication that you need to comply with IFRS, there's no need to say disclose the corresponding period. If the examiner chooses to do that, it's just your lucky day. But the question can be disclose PPE, full compliance with IFRS, end of the story. When you need to disclose, then on top of your head, as a good student, you'll know that you need to disclose both years. You know, that's full IFRS. But IFRS for SMEs, when you disclose your PPE note, you do not necessarily need to disclose the prior year or corresponding period. It's only one period, current year. I think I have said this before. When it comes to full IFRS, I've seen, even if people are told in the test that disclose the comparable period, others will just stick with 1 year. If there's 2020 and 2019, people will just disclose 2020 and losing so many marks because 2019 is also required. So remember, ladies and gentlemen, PPE, full IFRS, the note is full if you have got 2 periods. It cannot be just 1 period, unless we have been told otherwise. But if we complying with full IFRS, then it's both periods. If we are complying with IFRS for SMEs, it's just 1 period. So as I said, if the client is prepared annual financial statements using IFRS for SMEs, don't demand a comparable period, because IFRS for SMEs requires that you just disclose just 1 year. That is enough. You still have your opening balance, you still have your whatever activities that went through during the year, your disposals, your additions, your impairment, whatever else, and then you'll have your closing balance, you know, but you do not necessarily need the comparable periods. It's just for 1 year. Okay. Let's quickly now look at IS 38 full IFRS, which is intangible assets. Okay. Exchanged asset also just as at fair value as per PPE, doesn't specify fair value of asset given up or received. So it's the same principle as PPE when there's an exchange of asset for a non-monetary value. Key is that both R&D, which is research and development cost, are expensed under IFRS. You'll remember, if not, you can go back to your textbook. There are six criteria in your textbook where for in full IFRS now, that you can only capitalize development costs if those 6 criteria are met. If not, you can go back and remind yourself, but it's things like technical feasibility of completing the asset, intention to complete the asset and to either use or sell it, ability to use or sell the asset, how the asset will generate future economic benefits, you know, all those things. There are 6. So under IFRS for SMEs, no, we just the entire research and development costs, we just expense them. We do not necessarily need to go and test them whether are we meeting the 6 criteria that is there in full IFRS. Now, again, on intangible assets, there is no revaluation method that is available. Just like in investment property, it's only we carry it at cost, only at cost model. All tangibles have a finite life. That's very important. And if it cannot be established reliable, we just estimate. Management will estimate, but it cannot be more than 10 years. So that makes our lives easier. We know that all intangibles have definitely a finite life. So if in the question it's not given, I'll imagine it will be given, but in practice, if it cannot be established, then management will use some sort of estimate, will be not more than 10 years. Full IFRS requires an annual review, again, of things like residual value, useful life, and amortization method, same as we've covered it under PPE. IFRS for SMEs only requires such a review if there's an indication that there has been a significant change since the last reporting period. Same stuff. If a client is using IFRS for SMEs, then they do not necessarily need to review residual values for life and amortization. Same story as in PPE. When we disclose, we only disclose for the current year. It's not both years. It's just a reconciliation of opening and closing balance. Needs to be presented for just the current year. If it's 2020, it will just be 2020. 2021, it will be 2021, no corresponding period. And then the last part, full IFRS says we do not amortize goodwill. Hope you remember that. But under IFRS for SMEs, we can amortize goodwill. We can impair. Under full IFRS, the only thing that we do is we test for impairment at the end of the reporting period, not necessarily amortize it. But here we can amortize and then we can impair. We know how to do those, ladies and gentlemen. When it comes to what exactly do you need to do if there is some sort of impairment. All right, quickly let's look at lessees. IFRS for SMEs classify lessees just two: finance and operating lease. A lease is classified as a finance lease if it transfers substantially all risk and rewards incidental to ownership, whereas the lease is classified as an operating lease if it does not transfer substantially all the risk and rewards incidental to ownership. So when you are given a scenario based on the information, you can make a call to say, does this lease transfer substantially all the risk and rewards to the lessee or not? If, for instance, at the end of the lease period, the asset will be transferred to the lessee, things like that, then substantially all the rewards all the risk and rewards incidental to ownership will then be transferred to the lessee. So it will be a finance lease. If not, then it's just an operating lease. And then the finance lease, once we have classified it, the finance lease, you recognize the right of use of the asset, which will be depreciated. And then you'll have the lease liability, which is the finance costs and lease payments. And then under operating lease, the lease payments are just straight an expense, debit expense over the lease term, on straight line basis, simple and straightforward. There's nothing complicated. So that's what in IFRS for SMEs, we have got two. We have got operating, we have got the finance lease. Question to classify either of those: does the lease transfer substantially all the risk and rewards? Yes or no? If yes, it's the finance. If no, then it's the operating lease. Finance lease, you recognize the right of asset where we depreciate it over time, and then we've got the lease liability. Operating lease, we just expense it, debit. Okay. Right, let's quickly look at the provisions. Okay, now where you have got a provision, for what we know, you will have, when you disclose a provision in your note, you will have the carrying amount, beginning of the period, you will have things like the amount that was used during the year, if there is any reversal of unused provision, if any provision created in that particular year during the year, and then you will have the carrying amount. So that is more or less what you will disclose as a provision, the note that you will disclose. Okay. Now, you'll still do that under IFRS for SMEs. You'll still do that. Your note is still as it is. The only thing, as like the other items that we have looked at, the PPE, your investment property, etc., is that you will have only 1 year. Comparatives of disclosure are not necessarily required. So the note that I was just talking about, carrying amount, beginning of the year, whatever else happened during the year, then your closing balance at the end of the year will just be for 1 year, just like the other items that we looked at quickly. Okay, revenue. IFRS for SMEs divides revenue into two types. It's three, not two. You've got sale of goods, we have rendering of services, then we've got use of asset by another yielding interest, royalties, and dividends. Okay. Now, let's take the first one, which is the sale of goods. An entity shall recognize revenue from the sale of goods when all the following conditions are satisfied. Very important. All of those conditions must be satisfied, so that you can recognize revenue. And it's important that these conditions which we're going to be speaking about here, remember, they are applicable for IFRS for SMEs. When you get a question, recognition of revenue, it's fully IFRS. Remember, they're the completely different story. You've got here, you've got the entity has transferred to the buyer the significant risk and rewards of ownership of the goods. Entity retains neither continuing managerial involvement to the degree usually associated with the ownership, nor effective control of the goods. Amount of revenue can be measured reliably. It is probable that the economic benefit associated with the transaction will flow to the entity. And then the last one is that you can, when it comes to costs incurred or to be incurred in respect of the transaction, can be measured reliably. Okay, those are conditions for IFRS for SMEs. I hope you remember IFRS 15 talks a different language, from this. There you have got things like identifying the contract, identifying the performance obligations, determining the transaction price, allocating transaction price, all those. But for IFRS for SMEs, you just use this. For some of us, I remember this was IS 18, the old standard for revenue recognition before IFRS 15 came into being. So that's what is still there. So you need to just, from the information that you are given, see to it that you can see that definitely the significant risk and rewards of ownership of the goods have been transferred to the buyer. The seller is not retaining the continuing managerial involvement. The amount of revenue can be measured reliably, etc., etc. So you test through those 5 conditions, those requirements, and then you can recognize the revenue. When it comes to the sale of goods, which is the first item. The second item is the services. There, you recognize revenue if the amount of revenue can be measured reliably, probably that the economic benefits associated with the transaction flow to the entity, the stage of completion of the transaction at the end of the reporting period can be measured reliably. And then the last one, same as the other one, is the cost incurred for the transaction, and the cost to complete the transaction can be measured reliably. So here, when it comes to revenue, recognizing revenue from services, it's important to also determine the stage of completion. Here here, let's say, using your brother's example as well, if they are providing some engineering services to maybe let's say they are constructing a bridge. When it comes to stage of completion, they can use the proportion of costs incurred for the work to date, meaning how much work percentage-wise, whether it's 30% or 40%, that has been incurred in providing the engineering services. So then that percentage can be used then to recognize revenue, just as a way of an example. So that is that when it comes to services, if you're given a question, you'll have to sort of determine whether it's revenue, is it a sale of goods, or it's a service. If it's a sale of goods, then those 5 requirements in the previous slide. If it's the services that's been rendered, those 4 items, amount of revenue can be measured reliably, etc., etc. So you then test using those conditions, and then you can say whether we recognize revenue or it's not. But again, very important for IFRS for SMEs, not necessarily full IFRS. Okay, let's quickly look at the last one, which is the use of assets, where we're talking about interest, talking about royalties, we're talking about dividends. In that instance, excuse me, for instance, if we're talking about interest, we'll recognize revenue from interest using the effective interest method. If it's the royalties, we recognize revenue on an accrual basis. Excuse me, that one depends on the substance of the agreement. So whatever the agreement is saying, we are using some intellectual property, charging royalties depending on the agreement, then you'll recognize revenue based on that. If it's dividends, we only recognize dividends once the shareholder's right to receive the payment is established. Once we know that the dividend definitely have been declared and all conditions are met, then we can recognize revenue on dividends based on that. Okay, so again, here it's those items, but broadly, the condition is that it must be probable that economic benefits associated with the transaction will flow to the entity. And then second is that the amount of revenue can be measured reliably. Okay, so those are just 3 items. If you are using IFRS for SMEs, when it comes to revenue, you look at whether is it the provision of or supply of goods, is it a service, or is the right to use an asset, where we've got either we've got interest income, we've got royalties, or we've got dividends. So if in a discussion type question, you are asked to discuss, to recognize revenue, discuss recognition of revenue, that is where you will start broadly, that from IFRS for SMEs, we'll have to look at whether is it the sale of good, is it a service, or it's the use of an asset. And then you'll zoom into, depending on the information that you have, that you believe it's a service because of 1, 2, 3, and then you cover those conditions that are important if it's a service, those 4 items, then you'll have you'll be covered. There is no need for you to cover all 3 in details. You can just one statement, IFRS for SMEs, revenue recognition, we must look at whether it's the sale of a good, is it a service, or is the use of an asset, full stop. For this, depending on the information, then you test it to see if it's either of those 3, and then you go into those that are applicable to the one that you have chosen. Most importantly, when you do that, you then integrate it with the information that's given. That's how you'll get your mark. Repeating what is just here, whether it's the use of asset or it's a service or it's the sale of a good, will not necessarily. As I said, you may get half a mark, you may get 1, but the most importantly important thing to do is to integrate. Okay, happy. Let's move to impairment. Now, for IFRS 4 SMEs, because of the fact that the standard simplified our lives as accountants, basically we'll have less requirements when it comes to impairment. Those are some of the things that the development costs are expense. There are no intangible assets with indefinite useful lives, as I said. All of them must have a finite useful life. If they do not have a finite useful life, we'll have to have some management estimate which cannot exceed more than 10 years. So our lives from that perspective is more simplified. Okay. Lastly, if I'm not mistaken, when it comes to taxation, IFRS for SMEs only requires disclosure of the aggregate, current, and deferred tax on other comprehensive income items. Okay, that is what is required. It's just the aggregate of current and deferred tax. But when you go, if you can remember, when you go to full IFRS, it wants you to show tax effect on items that are going to be reclassified to P&L, tax impact on items that are not going to be reclassified. You know, the whole lot. It gives 3 options of how OC items and tax can be presented on the face of statement of comprehensive income, and consequently, what other disclosure would be needed in the notes. So if you are not sure, you can refer to your textbook there on page 355. But the good news when it comes to IFRS for SMEs, simplified, nothing complicated. It's just the aggregate of current and deferred tax. If there are other comprehensive income items that are needed to be disclosed, you know. So again, as I said, it's simple and straightforward. All right. I think, before we go to some short questions, ladies and gentlemen, is there any question? I haven't seen any coming. If you have any question, you can unmute, you can speak before we move to the short questions. Okay, doesn't look like we've got any, but you can still pose a question as we do the short questions. All right, let's start with the first one. Just a question: can a subsidiary whose parent uses full IFRS, or that is part of a consolidated group that uses full IFRS, prepare AFS using IFRS for SMEs? If we can use the examples that we used when we were going through the consolidations. What this question is saying, basically, let's take, we used the Massmat group. The Massmat group on top has got, let's say, Builders Warehouse. Can Builders Warehouse prepare its annual financial statements using IFRS for SMEs, whilst Massmat uses full IFRS? You can unmute, you can send chats. Anyone, ladies and gentlemen, any taker? Anyone, ladies and gentlemen? I'm still waiting. Can a subsidiary whose parent uses full IFRS or that is part of a consolidated group that uses full IFRS, prepare IFS using IFRS for SMEs. Made an example of a subsidiary of Massmart. Massmart, because it's listed on the JSE, it has got what we call public accountability. It needs to prepare its IFS using full IFRS. Now, can its subsidiary prepare IFS using IFRS for SMEs? Okay, someone saying yes, someone saying I don't think it can, since it has issued financial instruments to the public, issued shares to the parent, it has public accountability, therefore it must use full IFRS. Okay, any other takers? Someone said no, someone saying yes. Okay, let me help you. It can, but there is a but, provided it does not have public accountability. You know, if remember a subsidiary, I hear the comment that it has issued its shares to a parent. The fact that it has issued shares to a parent, when you issue shares, let's say I have a small company and I decide to issue shares. You come, you buy shares. That does not mean now that the company has a public accountability requirement or responsibility, as it were, you know, because it's just me, you, the company is not listed on the Johannesburg Stock Exchange. Just issuing shares to someone who is listed on the Johannesburg Stock Exchange does not necessarily mean then that particular company has got public accountability. Okay, so that company, it can use IFRS for SMEs and disclose whatever, just indicating that it relied or it used IFRS for SMEs. If you want that, you can look at IFRS for SME standard section 1.6. But that company, it's only if that particular company has also public accountability. If we look at, we take the company, we put it in the test to confirm whether it has got public accountability. If it does, then it must be fully IFRS. But if not, there is no requirement for it to go full IFRS. It does not necessarily mean that it can go full IFRS if it chooses so, but it can if it wants to just use IFRS for SMEs. Okay, I hope that helps you, ladies and gentlemen. Then let's look at the second one. Now, here is a parent with no public accountability. Can that parent prepare its separate financial statements? Note, it's separate financial statements using IFRS for SMEs and then consolidate using the full IFRS. Same Massmart. Let's say in this instance, Massmart is not listed as an example. Can it prepare its separate financial statements using IFRS for SMEs? But when it comes to consolidation, it consolidates using full IFRS. Can that be possible? Can a company do that? Any taker? As I always say, you can unmute yourself. You can talk if you want to, just to hear your reasoning. Otherwise, you can send it to chat. Someone saying, yes, it can use IFRS for SMEs since it has no public accountability. And then someone saying, no, they should also consolidate using IFRS for SMEs. Tobisi, I think you're saying it can prepare its separate IFRS using SMEs, but then consolidate also using IFRS for SMEs. Can clarify that's what, but the question, the crux of the question is, can it prepare its separate financial statements using IFRS for SMEs and then consolidate using full IFRS? Got two different answers. What do others think? Okay, let's see. The answer is yes. It may present its own separate financial statements in accordance with IFRS for SMEs, even if it presents the consolidated financial statements in accordance with either full IFRS or any other set of general accepted accounting principles, referred to 1.7. So a company, if it's not listed, no public accountability, it's not a bank, it's not an insurance company, it can use its, it can prepare its separate financial statements using IFRS for SMEs, but when it comes to consolidation, it has a choice to consolidate using full IFRS as well. Okay. On that note, when it comes to consolidation, the IFRS for SMEs, there is also a section that deals with consolidations. It does not necessarily mean that you'll find consolidations in the main or in the full IFRS. You can also find it in the IFRS for SMEs. Happy? Let's go to the third question. Now, this one is saying, let's take a scenario where there is a change that is being made in IAS 16 assets, the full IFRS. Does that change, or will that change be applicable to IFRS for SMEs, asset section, which is section 17? If there's any change, if the ISB were to make a change today on IAS 16, will that change automatically be applicable to IFRS for SMEs section 17? What do you think? Anyone who wants to take a bet? Anyone who wants to try? There's a change in full IFRS, any of the standards there. Will that change be automatically applicable to IFRS for SMEs? I think I've covered this in one of the slides. I did not state it directly, but if you were listening correctly, you would have picked up an answer when it comes to this one. And that was towards the end of my presentation. Someone said, if the change does affect SMEs, I think they should adopt it. Okay. Any other taker? Thanks, T, for that. You're saying if the change does affect SMEs, SMEs need to adopt it. Okay, let's see. The answer is a big no. IFRS for SMEs is a standalone standard. Changes made in full IFRS are not applicable to IFRS for SMEs. Okay, the first section, that part, P17. When I was towards the last slides, I was talking about revenue. I said the recognition of revenue using the IFRS for SME standard has got the old, shall I say, conditions or requirements as IS 18, as we used to call it. So when the revenue standard was changed to IFRS 15, those requirements for IS 18 are still as they are in IFRS for SMEs. So any change in full IFRS will not necessarily be applicable to IFRS for SMEs until the standard IFRS for SMEs has been changed as well. So if there's a new standard coming out tomorrow, changing anything in the full IFRS, it does not necessarily mean that the following day or the same day, then that particular change is applicable to IFRS for SMEs. It will be only when we get a new standard or variation of the IFRS for SME standards, then we can say it's applicable. Okay, hope that clarifies it, ladies and gentlemen. Let's look, which I think it's the last question. The application of the IFRS for SME standard by an entity with public accountability will result in fair presentation in accordance with IFRS for SME standard. Okay, there's someone who asked the question, what if the change was in IFRS for SMEs first? I think is relating, we were talking about the number 3, that there's been a change. If the change is in IFRS for SMEs first, that change will be applicable to IFRS for SMEs only, not full IFRS, until the full IFRS has been adopted. I think the key point here, let me quickly go back, is that it's this part here, that the IFRS for SME standard is a standalone standard. That's how ISB treats it. Just a standalone away from the full IFRS. So if there are changes that are made to the IFRS for SME standard, those changes are not going to be next day applicable to the full IFRS, vice versa. If the changes are on full IFRS, not necessarily, they will not translate to IFRS for SMEs automatically until there've been some changes. Okay, right. Now let's look at this question. What we're saying, what the question basically saying, it says, let's take an entity with public accountability requirement, sort of saying it's using the IFRS for SMEs standard, because then it says that will result in fair presentation if it uses the IFRS for SME standard in accordance with the IFRS for SMEs. In other words, will the use of IFRS for SMEs by an entity with public accountability result in fair presentation in accordance with IFRS for SME standard? Can you boldly say as an entity that because we have used the IFRS for SMEs, definitely that results in fair presentation, of course, in accordance with IFRS for SME standard? Any taker? Anyone? Okay, let's look at this one. The answer is no. Why? The application of IFRS for SME standard by an entity with public accountability will never result in a fair presentation of its financial position, financial performance, and cash flows, except if using full IFRS. I think here the issue I'm not sure why people are struggling. Is in any case, it's a company with public accountability responsibility. Narration got that one, yes, definitely, because it has got public accountability responsibility in any case. So it cannot rely, it cannot use IFRS for SME, for SMEs, for that matter. So it will never result in fair presentation of its financial position, performance, etc., etc. Right. Ladies and gentlemen, is there any question that you think